It's 8:24.5 on the phone from Tokyo now is Nick Smith, Japan strategist at CLSA. Morning, Nick.
Good morning to you.
We had an extraordinary day in the markets yesterday, particularly in the commodities sector, driving energy prices much higher. What impact is that having on Japan?
Higher energy prices? Well, obviously with the nuclear power plants shut down, Japan's a lot more exposed to energy prices than it has been in the past. It is a country that has done a fantastic job in reducing its energy intensity over time, but certainly that's going to be uncomfortable. So when we look at inflation, for example, the headline number looks like we don't have a whole lot, but that's mostly because of the downdraft from the previous prime minister having strong-armed the telco companies to cut their prices. Take that out, and we've got a couple of percent or so. So we'll see a surge in inflation from something in March, but particularly in April.
And can Japan find alternative sources from Russian coal and gas and oil if it needed to?
Well, I mean, its gas comes primarily from Australia. It's been improving the amount that it gets from the US. Obviously, it gets oil and gas from Sakhalin 2 up in the northern territories that the Russians took off Japan in the closing days of the war, which you look back on that and say, that's the reason why Japan doesn't have a whole lot of dealings with Russia. So, as an economy as a whole, it is surprisingly insulated from these problems. But gas, I think, the best thing that Japan can do to alleviate this problem is to start getting nuclear plants starting up again. It's not popular, but you remember at the tail end of last year, Kishida, the Prime Minister, said he wants to get them restarted, and he was thinking mostly of COP26, the greenhouse gas. Japan cannot uphold its promises under COP26 without restarting nuclear. And now he's got one further reason for absolutely having to restart those things.
And does this have implications for the Bank of Japan? It's been defending this 25 basis point ceiling on 10-year JGB yields now for a while, but obviously people are flocking into US Treasuries and driving Treasury yields lower after the last few days, although they did rebound a bit overnight. Is that helping the Bank of Japan at all?
I think that the Bank of Japan's going to hold absolutely steady. All of these years we've not got a whole lot closer to the target of 2% inflation. I would have thought that the Bank of Japan's going to leave things absolutely in place, and the tailwind it gets from Japan actually wants a bit of inflation, so we'll be there pretty close to target by April time.
And what does this mean for Japan's stock markets? Are the Japanese financial markets reasonably well insulated from Russia and any fallout from there?
Well, Japan's Russia is about sort of Japan's about the 10th largest trading partner for Russia. For Japan, Russia is even smaller. It's got a small trade deficit. Was it 681 billion with Russia? So a small trade deficit with Russia. It buys sort of oil and a certain amount of fish from Russia and sells it cars, car parts, and machinery, but for the auto companies and the machinery companies, it's a drop in the ocean. So it's reasonably insulated, but obviously markets are jittery everywhere. So actually, we're outperforming global markets reasonably well so far this year. So outperforming was at World ex-US by 2.2% and a bit less than that against global markets generally.
And what sectors in the Japanese market would you look at in this sort of crisis?
I think it makes sense to be just looking increasingly at defensive sectors. What I'm suggesting is get yourself into domestic rather than global sectors. Consumption has been absolutely hammered through the pandemic, just because Japan has been so perfectionist about trying to drive down case counts. So I would say domestic side, things like the retail companies look quite interesting, and then lightening up a bit on the sort of the interest rate sensitive things like banks and financials, for example.
So financials are the things you would keep away from in particular, presumably in line with what's happening elsewhere in global markets.
Yeah, I mean, I think longer term, you'd have thought that interest rates will be headed up, and value and high dividend yield will do very nicely. But over the short term, I think they're getting sold off at the moment, and I think that's understandable.
Nick, thanks very much. Always a pleasure to talk to you. That's Nick Smith, Japan strategist at CLSA in Tokyo.